Good morning, everybody, and welcome to the weekly podcast on fundamentals and technicals of the market. Last week, the US market posted modest weekly gains for the week ended May 29. The number of Americans filing new claims for unemployment benefits fell below 4 lakhs for the first time since March 2020. However, job creation disappointed in May with non-farm payrolls at 5,59,000 but still short of lofty expectations of 6,71,000. The unemployment rate fell to 5.8% from 6.10. Markets are actually reacted positively to Labor Department data as the investor hope that this could keep the Federal Reserve from tightening monetary policy. As per media reports citing sources, US President Joe Biden offered to drop plans to raise corporate tax rates as high as 28% and instead set a minimum 15% tax rate aimed at ensuring all companies pay taxes. The major and impacting factor, crude prices. Crude oil. Crude prices have been rising steadily since the start of this calendar year, and Brent crude is now trading very close to $72 per barrel. Increased demand for economic recovery post-lockdown is supporting crude oil prices. Deregulation of petrol and diesel prices has improved cash flows for oil marketing companies, but we cannot forget that it's a significant part that we import in our total import bill, and that is why it is negative for emerging markets as well as for our markets. Government has focusing on alternative energy and the companies are investing accordingly. Apart from that, government is pushing for electric vehicles that will lower petrol diesel consumption, and recently the government also advanced the target for mixing 20% ethanol in petrol from 2025 to 2023. Apart from reducing oil imports, higher ethanol mixing is also positive for sugar companies. This development is also positive for Praj Industries as new capacities are expected to be set up for processing ethanol. Briefly, let's have a view on the domestic macros. Q4 GDP data showed that economy was on a gradual path. The Monetary Policy Committee, as expected, kept the policy rate and stance unchanged given the growth uncertainties arising from COVID. It revised down financial year 2022 GDP growth to 9.5%, while inflation, though revised slightly higher, remains within RBI's target band. We expect repo rate and policy stance to remain unchanged during financial year 2022. The southwest monsoon made onset over Kerala coast on Thursday after a delay of few days. IMD upgraded its monsoon forecast and said the country would receive normal to above normal rainfall with well distributed showers in the month of June and September. Few results of the last week. Bharat Forge reported strong number and we expect a strong recovery in commercial vehicle. Also in industrial segment, led by higher demand for freight and increase in government capex. However, valuations are too expensive. ITC also reported their numbers in the previous week. ITC offers a combination of one, inexpensive valuation, second, healthy dividend yield, and third, the promise of robust growth in FMCG. On steel front, China dampened sentiment but fundamentals are intact. We see only a sentimental impact of recent Chinese regulator warning against commodity price speculation in China. The underlying market fundamentals remains robust, led by China's determination of carbon neutrality, demand recovery in the south, in the west, and limited supply flexibility. Recent margin strength and structural reforms led by China suggest upside for earnings and fair value. Tata Steel is our preferred play. Weekly pick for the current week is Escorts Ltd. We are recommending Escorts Ltd as our weekly pick. We believe the tractor industry is likely to show strong growth over the next 2 years, led by good monsoon over the past 2 years, stable crop prices and higher Rabi crop output than the previous year, and higher mix of non-agriculture based tractors. As talked earlier, monsoons are likely to be normal as per IMD, and that is positive for farm income and tractor demand. Company is net debt free. We have a buy rating on long term fundamental, price target of rupees 1700 on the stock. Expectations of normal monsoon, accommodative stance by RBI, decline in fresh COVID cases in India, gradual easing of lockdown restrictions and positive global cues would likely lend support to the market in the near term. On a weekly basis, for the third consecutive week, the market closed in the positive territory under the leadership of the energy sector. NBFC's auto and commodities also helped the market to close above the highest level of the previous rally, which was at 15,431. During the week, FIs sold to the tune of 4,500 crores, but in the month of June, to date, the FIs infused net 1550 crores in the equities. Technically, 15,550, 15,400 would be major supports, and on the higher side, 15,800, 16,000 and 16,200 would be major levels to arrest the bulls. The basic trend of the market is bullish, but in the absence of domestic news flow, our markets would start following to the global cues, which are mixed and sensitive to the pace of inflation. In the current week, global cues could dominate the market. For the week, the strategy should be to buy on dips between 15,550 and 15,450 levels, with a stop loss at 15,350 on the downside. The focus should be on auto, insurance, commodities and technology stocks. That's all from my side. With this, I'm ending morning podcast. Thank you very much for listening in, and have a great day to all of you.